Welcome to Scottsdale, Arizona. I hope you're enjoying your time here, getting a lot out of your meetings. My name is Ryan. I'm with Bitwise Investments. We are a crypto specialist asset manager. I'm thrilled to be kicking this session off with you today. Thank you for joining. We're going to cover a lot of ground today. So we are going to look at Bitcoin and Ethereum. Why do these assets have value? We're going to look at the tokenization of real-world assets and stablecoins and talk about how these technologies are fundamentally upgrading the financial system. And then we'll give you a crypto market update and look at where we go from here. I'm thrilled to introduce the speaker for this session. He is the Chief Investment Officer of Bitwise Investments. If you've been in the industry for a while, you'll remember him from his time as CEO of Inside ETFs and ETFs.com. I find him to be the most pragmatic thinker in crypto. I think you'll feel the same. Something we pride ourselves here at Bitwise is educating you, keeping you up to speed on everything that's happening in crypto so you can have effective client conversations. And that's what we're going to do today. So please join me in welcoming Chief Investment Officer of Bitwise, Matt Hougan.
All right. Thank you, sir. All right. How's everyone doing? Good? Awesome. What an event. It's amazing to see this. Uh-oh, we blinked away. There we go. Let's get a feel for the room. How many people in here own crypto? Wow, look at that. My, has things changed. How many people who are advisors own crypto and client accounts? Oh, we got a few. That's great. How many people think crypto is crazy going to zero? I saw 2 hands at least, so there are a couple honest people. All right, great. I want to do a lot of things. I'm going to assume there's a wide variety of expertise in crypto. So we're going to start at 101. Before we do, just a minute about Bitwise. We're a global crypto asset manager. We've been around since 2017, manage about $15 billion across US ETFs, European ETFs, staking vaults, SMAs, and alpha strategies. We're about 200 people, and we pride ourselves on doing research. I co-authored the CFA Institute's first ever guide to crypto, and we love doing presentations like this. We have a great executive team, but this is not a sales pitch. We have a bunch of tickers, but also not a sales pitch. Our team is here at a table if you want to talk to them. I will leave this up for the advisors in the room. One of the unique things Bitwise does is if you get a question from a client about crypto that you don't know the answer to, you can email us, and my 18-person research team will give you a compliance-approved answer that you can use in conversing with your client. So that's just a nice offer, something that we love to do. We field a half dozen to a dozen of those questions every day. All right, I'm going to start with Crypto 101. For the skeptics out there, that's you, and I saw one over at that table. I want to talk about why Bitcoin has any value at all, and then I'll talk about how to value Bitcoin, and then we'll do Ethereum, and then we'll move into the market update part of the presentation. The question I get about Bitcoin is, how does this intangible asset that has no cash flows worth $1.5 trillion? You can't touch it, you can't feel it, doesn't produce anything. How is it worth $1.5 trillion? In fact, how is it worth anything? And the way I like to describe it, this may be helpful if you're conversing with clients, is Bitcoin provides a service. And the service it provides is the ability to store wealth in a digital format without relying on a government or a bank. That's all it does. It lets you store wealth in a digital format without relying on a government or a bank. I like describing it as a service because we're all used to services having value. If you think about Microsoft, Microsoft offers a service. So the ability to edit Word documents and do Excel and get angry at Teams when it doesn't connect you to people. But we know why Microsoft has value. If you want their service, you subscribe to the service, you send them a check. The more people who want their service, the value of Microsoft goes up. If fewer people want it, the value goes down. If no one wanted it, the value is zero. The same thing is true of Bitcoin. If more people want this service, the value of Bitcoin will go up. If fewer people want it, the value will go down. If no one wants it, the value is zero. The reason Bitcoin's gone from $0 to $76,000 is that at the beginning, no one wanted this service. And today, Harvard Endowments wants this service. The Abu Dhabi Sovereign Wealth Fund wants this service. Turns out the majority of the room wants this service. An increasing number of people want this service. The difference between Microsoft and Bitcoin is Microsoft is a company. So if you want the service, there's someone to send a check. You can't subscribe to the Bitcoin service. You can't pay a monthly fee. The only way to get the service is by buying the asset. If you buy the asset, you get the service. But the reason it has value is a lot of people want this service. How much value? Well, before we do that, let's talk about the quality of this service. A criticism I get is this is a terrible way to store value. Look at these pullbacks, 60%, 40%, 39%, 45%. This thing is not a great store of value. But of course, that's not Bitcoin, that's gold. We do have this perception of stores of value of being perfectly linear. They always protect you exactly. Bitcoin's designed to protect you against the ravages of inflation over time. Since the bottom of COVID, the US dollar has lost 28% of its value, and Bitcoin is up roughly, what is that, 20x. So it's done pretty good of protecting you against inflation. How big could it be? Well, the market for gold today is 33 trillion. There are 21 million Bitcoin. If Bitcoin matches the size of the gold market, every Bitcoin is worth 1.6 million. This is something that people trot out, but I think they make a mistake, which is this. I see some old ETF friends in the audience, and many people will remember when the gold ETF launched in 2004. At the time the gold ETF launched, the entire gold market was $2.5 trillion. That was the size of the market. Today, that market is $33 trillion. So one of the reasons that past slide is confusing is it supposes Bitcoin has to get to be the entire size of the gold market to be worth north of $1 million. But that forgets that the gold market has grown over time. This is how we value Bitcoin. We look at all the different markets Bitcoin is going after. It's going after the institutional investment market. Again, Harvard's largest liquid position is a Bitcoin ETF. It's competing on the edges with emerging market currencies. It's used to store offshore wealth. But the biggest one is this store of value market with gold and Bitcoin. The thing about this slide that I find really convincing is what we've done is we've taken the current market size of gold, which is 29.4 trillion when we did this slide, and we've looked at the historical CAGR. That market's been going 12.9% for the last 20 years. And what we've done is we've imagined, what if that continues for the next 10 years? What if the market continues to grow? It doesn't grow faster because there's more debt. It just continues to grow as it's been growing. And then what if Bitcoin takes various shares of that market? You can see in our base case, Bitcoin takes 25% of the market. Right now it's at about 6. Over the last 10 years, it's gone from 0.1 to 6. So that's 60x. We think it's going to go from 6 to about 25. So we think it's going to take about 4x market share over the next 10 years as millennials get older and Gen Z gets older and Morgan Stanley rolls out Bitcoin ETFs and Goldman Sachs rolls out Bitcoin ETFs. We think it could take 25% of the market. With just those two assumptions, if the gold market continues to grow and Bitcoin continues to take market share, in fact, it takes market share slower than it has in the last 10 years, every Bitcoin gets to $1.3 million by 2035. I think those are reasonably conservative assumptions. I actually think the store of value market will grow more because we're reaching such a huge point of debt and because the world is fracturing and we're starting to pay $1 trillion in interest. I think there's a risk that that store of value market will grow faster than it has over the last 20 years. But even if it just grows at the same rate it has over the last 20 years, and Bitcoin continues to take market share, it's 1/4 the size of this market, every Bitcoin gets to $1.3 million. I like throwing those out because when I joined Bitwise 8 years ago, people would say things like, Bitcoin's going to be $1 million, and I thought they were insane. Nothing goes up that much. But I think these are reasonable assumptions. And if Bitcoin does more than that, you can see it gets to about $3 million. Actually, if Bitcoin's market share collapses from 6 to 2%, then it more or less trades flat. So anyway, that's how we value Bitcoin. Let's do Ethereum. Ethereum is the second largest crypto asset. Like Bitcoin, it provides a service, but its service is very different. People think of Bitcoin and Ethereum like they think of the dollar and the euro, two versions of the same thing. A better comparison is like Google and Salesforce. Both Google and Salesforce are built on the internet, but they do different things. Bitcoin and Ethereum are both built on blockchain, but they do different things. What does Ethereum do? Ethereum offers the ability to transfer and settle dollars, stocks, bonds, and other assets globally at extreme speeds and low cost. It's a network for moving other assets. You've heard of stablecoins. Those are digital dollars moving over a blockchain. You've heard of tokenization. Those are stocks and bonds moving over a blockchain. And it's really good at it. I set up a race here between JP Morgan and Ethereum for sending money to Australia. For context, JP Morgan's CEO makes $38 million a year. They have 300,000 employees. They have 5,000 offices in, I think it's 40 different countries. And the cost to move money to Australia is about 40 to 50 bucks. It takes 1 to 5 business days. Ethereum has no CEO. It has no offices. It has no employees. There's no entity called Ethereum. And it can move an infinite amount of money to anyone around the world in about a second for a fee of less than a penny. The reason blockchains can move money so much faster than the traditional financial system is actually not magic. It's actually really simple. They remove intermediaries. I want to explain this because very few people sort of take the time to get this. Think about the last time you moved money between your checking and your savings account at your bank. It happened instantaneously, right? You can move it back, you can move it 20 times a day. Why does that happen instantaneously? Whereas if you send money from your bank to my bank, it takes a day to 3 days. The reason is in your bank, they have a record of every account. It's one database. So if they want to move money from your checking to savings, they can just change it like an Excel document. When you send money from Chase to Wells Fargo isn't going to credit me until it confirms with Chase you have the money. And so there are these two databases and they have to talk to one another. The reason JP Morgan takes so long is that money has to move from here to New York to London to Sydney and then to a local bank. And each of those hops take a long time. What a blockchain is, the whole computer science revolution behind blockchain, is a question of how you create a global database that's available to everyone, that updates in real time, that's always accurate, that anyone can interact with, but isn't controlled by any one entity. So if I'm moving money from me to my friend Ryan or someone in Australia, it moves as fast as moving money from a checking to savings account. Again, the checking to savings account is one database, so it moves fast. Bank to bank is two databases, so it moves slow. Blockchains are one database, but available to everyone. So they can move money faster than the largest bank in the world, much faster than the largest bank in the world, and the largest bank will never, ever catch up. Why does this matter? Well, it matters because I think all assets are going to move over blockchains because they're infinitely faster than the existing system. Not incrementally faster, but infinitely faster. I actually think there's no way for the existing system to catch up. And we're very early in that growth. There's currently $300 billion of tokenized assets across dollars, treasuries, global bonds, etc. And there's $674 trillion of assets in the world. All of that, I think, is going to end up moving over blockchain. And that benefits the blockchains on which it moves. Every time you do a transaction, even if it's only a penny fee, that fee is paid in ETH and it's burnt and benefits the Ethereum blockchain. In fact, if you look at the largest producers of revenue on the Ethereum blockchain, it's mostly stablecoin companies that are moving money from one person to another. Tether paid about $2.7 billion in fees to the Ethereum blockchain. Now, if you think about this slide, going from 300 billion to $674 trillion, and then you think about this slide, at 300 billion, we're already generating this level of fees. You can see why people are excited about Ethereum. I don't have time to do all the other assets, but the thing I wanted to make on this slide is that every step of the financial ecosystem can potentially be disrupted by some version of crypto asset, whether that's lending or trading or other forms of execution. And if I were to list the next 10 crypto assets, we would hit on assets that are doing similar things. So again, sort of to summarize the 101, and then we'll talk about the current market environment. Bitcoin is a service. The reason it has value is that service is valued by people. It's the ability to store wealth in a digital format without relying on a government or a bank. Ethereum is a service. The ability it offers is to move assets around the world drastically faster than the traditional system. The reason it has value is people value that service as well. All right, let's talk about what's going on in the market. I think it's one of the rare moments in crypto's history where fundamentals are ahead of the price. What do I mean by that? Crypto is definitely the land of hype and hyperbole. We're always reinventing all of finance and recreating money. But usually the market has overpriced that. I'm going to argue that the market is underpricing the growth in fundamentals. So I have a bunch of slides here. Here are some fundamentals on crypto. I'll just walk through some of them since we have some time. That's the total Bitcoin held by ETFs in the upper right. That's institutional investor ownership of ETFs of Bitcoin. Here it is of Ethereum. Here's corporations holding Bitcoin and corporations holding Ethereum. You can see that these are probably the 4 best measures of institutional interest in crypto. They're all up and to the right, including in Q1. There's the number of transactions taking place on the Ethereum network. You can see it spiked recently. Here's the number of transactions taking place on Solana. That's the biggest competitor to Ethereum. You can see it spiked recently. There's the amount of loans on Morpho. That's a place where you can borrow assets against crypto assets. You can see it's gone up recently. This is a chart of Coinbase volume versus Uniswap volume. Uniswap is a decentralized exchange that uses crypto-based rails to automatically execute trades. And you can see the black is Uniswap. It's actually gaining share on Coinbase over time. Here are a few more. This is a chart of the tokenized real-world assets. These are stocks, bonds, commodities, etc., that are moving over blockchain-based rails instead of the traditional system. You can see it's up and to the right. There's stablecoin AUM. It's up and to the right. Here's tokenized treasuries. It's up and to the right. And there's stablecoin transaction volume in green versus Visa transaction volume in black. What's that showing you is that for the last 2 years, more money has moved over stablecoins than has moved over Visa, which is an incredible fact. And last year, it was about 1.5 times as much. So all these fundamental metrics are up and to the right. We also have massive progress on the regulatory front. I don't have to tell you that we have a very pro-crypto administration, a pro-crypto SEC, a pro-crypto CFTC, a pro-crypto OCC. All of these are moving forward positive things in the crypto ecosystem. And yet, the price is down. This is a chart of the Bitwise 10. That's our index of the 10 largest crypto assets. And you can see since the administration came in, the price is down 27%. Okay, so how do you square those two things? Fundamentals all up and to the right. In fact, some of those charts are like this. And prices down and maybe recovering. And the answer is there are 2 kinds of crypto investors. There are retail investors who are the original crypto investors. They're the people who bought Bitcoin when it was $1, $10, $100, $1,000. It's your insufferable friends who have nice vacation houses or yachts and told you about crypto and you should have bought it, but you didn't. If you want, you can ask me later about the meeting I had when Bitcoin crossed $1 and how I didn't buy any. And then there are institutional investors, which is the new wave of investors coming in. These are the ETF investors. These are the Morgan Stanleys. These are the Goldman Sachs, etc. The thing people forget about crypto, because there's been so much institutional story over the last 2 years. We just saw in this audience, most people raised their hands. 3 years ago, I'd have a few people raising their hands. There'd be more people who thought crypto was going to zero than who owned it. What people forget is that most Bitcoin is held, most crypto is held by individuals. About 2/3 of all Bitcoin is held by individuals. Institutions are really this 7%. So they're a tiny fraction of the market. And the reason that the market has been down, this is going to seem too simple, is that crypto has had a 4-year cycle historically. So this is a look at the returns of Bitcoin starting in 2011 when it first started trading. And you can see it follows this familiar pattern of 3 big up years and a pullback year. 3 big up years and a pullback year, 3 big up years and a pullback year. There are various reasons it follows this pattern. Bitcoin has a halving every 4 years. Interest rates have spiked in 2018 and 2022. It doesn't actually matter. For the point of this presentation, what matters is that this pattern is so obvious. And so what happened last year is a bunch of people who bought Bitcoin in 2011 or 2015 or 2019, and who were sitting on huge gains, looked at this and said they didn't want to live through Bitcoin dropping 58 to 74% again. If you have $10 million of Bitcoin and you paid $100,000 for it, do you really want to see that go to $2.5 million of Bitcoin? You don't. And so beginning in July of last year, these people started selling. Last year, corporations and ETFs bought $80 billion of Bitcoin. That's a lot. It's the most successful ETF launch of all time. And then you had corporations following on top. Retail individuals, and particularly long-term holders, sold about $100 billion of Bitcoin. And so the price went down. In 2026, they also sold more, although in February, they stopped selling. So you can see actually in this chart that the prices have been recovering since the end of February. And I think I have one more chart. This is a chart of the long-term holders of Bitcoin. So these are the people who have held Bitcoin for a meaningful period of time. And you can see that between July and February, they sold about 400,000 Bitcoin. That's a lot of Bitcoin. And I think they were selling because they were afraid of the 4-year cycle. And since February, they've been buying. The reason this is important is if you have institutions buying, and I think you will, Morgan Stanley just launched a Bitcoin ETF. It's had 13 straight days of inflows. It's approved on every major financial platform at this point. And you have retail investors who own 66% of Bitcoin, either neutral or buying. I think the outlook is pretty good. So I guess to sum up that section, usually in crypto's history, it's been more hype than substance. At this particular moment, it's more substance than hype. And I think there's reason to believe that the recent recovery could stick as long as retail investors keep buying. All right, I want to talk about 3 forces to drive the next market move, and we'll save time for questions at the end. These are sort of the 3 things that I think are going to make or break crypto over the next year. I want to talk about stablecoins and tokenization in case people aren't familiar with them, talk about regulatory progress, and then talk about institutional access. Let's talk about stablecoins and tokenization. Stablecoins, if you don't know, are digital dollars printed on a blockchain. The way a stablecoin works is you send money to a stablecoin issuer, and they invest it in short-term treasuries, and they give you a digital receipt, which is called a stablecoin, that's printed on a blockchain like Ethereum. And then you can move that on that blockchain instantaneously. If you ever want your money back, you can send the stablecoin back to the issuer. They'll sell the treasuries and give you money. It's like a money market fund, but in crypto. You can see that stablecoin AUM has gone from 0 to about $350 billion. A lot of people ask, what are stablecoins used for? There are actually a lot of uses. The first one was crypto trading. If you hold Bitcoin and you want to rotate out, but you don't want to move your money to a bank, you would rotate out into a stablecoin. So you would hold your money in a crypto native token. That way you could deploy it instantly. Because if you rotate it to a bank, it would take 3 days. That's what stablecoins were developed for. But what we found is they have all these enormous uses. If you look at that chart, look at Africa. That country in red is Nigeria. Why is Nigeria in red? That's a crypto adoption index. Why does it have the highest level of crypto adoption actually in the world? The reason is that the Naira is very volatile and indeed collapsing. And what people in Nigeria are doing is they're using their cell phones to access dollars via stablecoins. In fact, there was recently a BIS report last week that said that stablecoins were driving emerging market currency collapse risk in countries like Nigeria. So in basically every country around the world that's experiencing high levels of inflation, you're seeing people migrate to stablecoins because now they have a US bank account in their pocket that they can access with a few clicks. And it's not just that. People are using it for remittances because, again, you can send these anywhere in the world instantly for the cost of a penny. And they're using it for B2B finance, particularly in the global south, where banks are slow and often charge high fees. So you're seeing huge growth in international commerce. Just last week, DoorDash announced it was going to start paying its Dashers in 40 different countries using stablecoins. Elon Musk's Starlink charges customers using stablecoins. This is a big change, and it all moves over blockchains. This is the U.S. Secretary of the Treasury. He thinks that stablecoins are going to grow from $300 billion to $3.7 trillion. And remember, every time a stablecoin moves, it benefits crypto investors. This is tokenized real-world assets. So these are stocks, bonds, etc., printed on a blockchain. This is the fastest growing chart, I think, in finance. I think you should expect all assets to be tokenized in the next 5 years. And it's not just me. This is Larry Fink. He says we're at the beginning of the tokenization of all assets. This is Vlad Tenev. Tokenization is like a freight train and can't be stopped. And this is David Solomon. We have a huge number of people working on tokenization and stablecoins. I like bringing this up because this is like a real revolution that's happening in finance. And I think people are skeptical because it's all based on crypto-based rails. But the U.S. Secretary of the Treasury, the CEO of Goldman Sachs, the CEO of BlackRock, the chair of the SEC is telling you all assets in dollars are moving on chain, and they're all going to move over basically crypto-based rails. So we think that's a big change that's happening this year, and investors should be exposed to it. The next one is regulatory progress. We made huge progress from a regulatory perspective. At the start of 2025, the SEC was suing all the names on this list. Basically, every firm involved in crypto with a market cap over $1 billion faced an SEC lawsuit. Those lawsuits have all since stopped, and the administration is engaging with crypto. Now, a lot of people wonder, could this just reverse in a new administration? And I think the answer strongly is no. So this is a look at the voting for the Genius Act. The Genius Act was the first piece of crypto legislation ever to get through Congress. It covers how stablecoins are regulated. And the interesting thing here is that it had very significant bipartisan support. In fact, it was the third most bipartisan bill to pass Congress in 2025. The first was something that was anti-fentanyl. The second was a meaningless act. And then there was the Genius Act. Why do both parties support the Genius Act? Because stablecoins being used in emerging market countries and used for global commerce drives money into treasuries, because every stablecoin is backed by a treasury asset. And the one thing both parties can agree on is that they like to spend money and issue debt. And so stablecoins are now the marginal buyer of US debt. They're actually, as a country, I think like 11th in terms of owning US debt. And that will probably be number one in the next handful of years. And so all of Congress is now sort of aligned behind stablecoins as the big solution to US debt. At the same time, you have big firms like BlackRock and Goldman Sachs, NASDAQ and NYSE, the entire finance industry preparing for this tokenization wave and pushing crypto forward. I think it's highly unlikely that we reverse and go back to the previous regulatory administration. This is the next piece of crypto legislation that's pending in Congress. This provides a general guidance for how crypto will be regulated. The polymarket odds are now right around 50%. If this passes in the next month, I think it's off to the races and crypto will end the year at new all-time highs. All right, let's see. I want to get to the Q&A section, but let me do a little bit on institutional access. I think crypto is dramatically moving into institutional portfolios. This is a look at the growth of crypto ETPs, AUM, since they launched. It, yes, goes up and down because the market is volatile, but it's been by far the most successful ETF launch of all time. I say that, and I'm not sure people always process that. There were 8,000 ETFs launched until the Bitcoin ETFs. The most successful was the NASDAQ 100 Qs, which launched in 1999 and pulled in $6 billion in assets. The Bitcoin ETFs brought in $36 billion in assets. They were 6 times larger than the second largest ETF launch of all time. And those flows have continued. We suspect they'll continue to grow. I'm showing here in black the flows into gold ETFs year by year. The history here, there are a lot of ETF people in the room, so you know this. ETF flows tend to accelerate over time as they're approved on platforms and as advisors get comfortable with them. We think that the ETF flows we saw in year 1 and year 2 will accelerate now that you can buy those at Morgan Stanley, at Merrill Lynch, at UBS, at Wells Fargo, at other major wealth platforms. So we expect these numbers to continue to grow up. Here it is. Morgan Stanley launches its first bank-run Bitcoin ETF. Again, they've had 13 straight days of inflows. Here's Goldman Sachs. Here's Charles Schwab. I don't know if anyone saw on Twitter, Charles Schwab put out a video about adding Bitcoin to a portfolio, suggested people put between 2 and 7% of their assets into Bitcoin, which is more than Bitwise recommends. So when you have Charles Schwab moving the Overton window beyond what a crypto asset manager says is standard, it tells you that the market has really shifted. I want to close quickly with investing in crypto, and then we'll move to Q&A. I know I've covered a lot in this presentation. Jack Bogle is one of my heroes. This is not the only way to invest in crypto, but this is how I do it. His advice was don't just find a needle in the haystack, just buy the haystack. That, of course, is driven by this kind of data, which shows the vast majority of active managers underperform. This is really true in crypto. This is a Cowan chart of the 10 largest crypto assets month by month. The thing to take away from this is that people think of crypto as this one thing, and it's really, really not. Remember the start of this presentation, I talked about how Bitcoin was like a digital gold and Ethereum was like a digital NASDAQ. They're very different. And what this chart I really want to hammer home is that in any month, the difference between the best and worst performing crypto asset is really significant. In fact, the average monthly dispersion is 34%. as on average month between the 10 largest crypto assets, there'll be one that's 34% different from the other. That's vastly more than the stock market. As a result, both we and some other providers, I know both Hashdex and Grayscale are in the room. For what it's worth, with Bitwise, the 3 best crypto asset managers, so you have great people to talk to today, all provide index-based products that make it easy for advisors to gain broad-based exposure to the space. This is ours, but you should, of course, talk to everyone. Just to conclude, I really think this is a really unique moment for crypto. I love talking to people about crypto right now because it is that rare moment where the fundamentals are up and to the right and the prices are sort of down and leveling out. And it's almost never happened in my 8 years of working at Bitwise. I think there are enormous structural catalysts that the market is overlooking. I think the growth of stablecoins and tokenization is so much bigger than the market anticipates. Remember, we're at $300 billion in assets on those platforms. There's $674 trillion of assets that could move on those platforms. Goldman Sachs, BlackRock, the SEC are saying they're going to move in that direction. That is a step function change. And if you have 0% exposure to crypto in your portfolio, you don't have any exposure to that. Beyond that, it's an exciting market and you're an exciting crowd. So I want to answer your questions. That's it for me. What questions do we have? Yeah. Yeah, sure. So the question is about tokenized assets. There are 2 ways people tokenize assets, and then I'll talk about what it means for the financial ecosystem. One is to create like a warehouse receipt, where you take an asset and you put it in a box, and then you issue a digital receipt, and that's your tokenized asset. You trade it like that. That's sort of V1 of tokenization. V2 is to do it natively on chain, to do like IPOs issued on a blockchain. We're not at that phase yet. It's mostly this warehouse receipt concept. Right now, we're in the experimentation phase where people are doing it on multiple different blockchains to try to figure out which blockchain is the best for them. They're doing it with multiple different wrappers. They're leading firms like Superstate and Securitize and Canton Networks and others that do it slightly differently. So I'd say we're in the exploration phase. I think that's going to be hammered out over the next 2 years. It will mean some really different things for how finance works. Tokenized assets trade 24/7, 365. There's no nights or weekends. You never get to sleep. Tokenized assets are very easy for people to borrow against. So the level of borrowing that takes place against assets is going to explode. Tokenized assets are very easy for people to leverage against because it's pristine collateral, unlike a traditional system. So the amount of leverage in the system, I think, will grow. And I think every firm is going to have to reorient around this 24/7 framework. It's going to be a real big change. The way I think it will happen, for what it's worth, is not that overnight the US will move to tokenized assets. Tokenized assets will serve audiences that aren't served by the traditional system. They'll serve crypto audiences. They'll serve global audiences. Now, in fact, if you're abroad, one of the easiest ways to buy stocks is to buy a tokenized stock on something like X stocks if you're in Europe. And it'll be perfected over there and then eventually merge into the US system. That's what I suspect. Yeah. More questions? Yeah. Great question. In the early days of crypto, it was mostly all bad actors. You probably remember Silk Road as like a drug marketplace where you paid for Bitcoin. That really changed in 2019. In 2019, what happened is OFAC applied KYC rules to all digital asset service providers, which means if you're Coinbase or you're Binance, you had to KYC your underlying customer. As a result, what you see, even in the government's data, is the amount of illicit use, in particular of Bitcoin, fell by about 50% in 2019 and then continued to go down from there. So Bitcoin today is primarily clean because it's extremely traceable. It's a little bit like if you steal a piece of art and then you try to sell it, you'll probably get caught. The same is true in Bitcoin. If you use Bitcoin for an illicit purpose and then you try to move it into the traditional system through any major exchange or any online entity, your asset will probably get seized. So for Bitcoin specifically and major crypto assets, it's limited. Where we do see a lot of illicit activity is 2 places that haven't been stamped out. One is there are a couple of different crypto assets that are so-called privacy coins. They're assets like Zcash and Monero, where unlike Bitcoin, you can't trace a transaction. In Bitcoin, you can trace a transaction. These deliberately obscure that, so you can't. And actually most like kidnapping and stuff money moves over these privacy coins now. I think those will be made illegal. We won't hold them. No institution will hold them. You can't custody them. I think they'll be illegal. And then the other major bad actor is actually North Korea, which has a major hacking organization trying to hack into various DeFi to steal money. And they're very successful at that because they're good at cybersecurity, and DeFi is a new frontier. So it's still a problem. But by and large, the criminal activity was dramatically reduced in 2019. And now I would say it's on par or less than the traditional system. That may not be good. The traditional system has a lot of illegal activity, but it's not meaningfully worse outside of those two areas of privacy coins and then hacks related to bad nation actors.
I was just hoping you could talk a little bit about XRP.
Sure. XRP is another blockchain that was created by a company called Ripple. Let's see, XRP is used to move money quickly around the world. It's actually one of the most efficient blockchains in the world. In order, the cost to run it is actually roughly zero, whereas the cost to run Ethereum and Solana is relatively high. XRP went through an interesting journey, which is it was an early actor, and then it was sued by the SEC. And it was effectively a business-to-business blockchain. They were trying to get businesses to use it. And if you are a business blockchain and then sued by the SEC and declared an illegal securities offering, no business is going to do business with you. And indeed, that's what happened. So XRP was sort of like frozen for 4 years under Gary Gensler, fighting a legal battle. They were then, in the new administration, that lawsuit was dropped. They had already lost a few times in court, but that lawsuit was dropped. And so they were freed to actually compete. The question around XRP is that now that they can compete, can they win? And what you see in the data is so far, they've only gotten modest traction, not zero, but modest. So they're not of the scale of Ethereum, Solana, etc. But they are backed by a company with an enormous balance sheet that has interesting assets. And so my view of XRP is we don't know if it will win or lose. There's a reason it didn't succeed in the past, which it was being sued by the SEC. That reason is released. There's now a strong community and a strong company pushing it forward. And so it's part of our index, and I'm glad it's part of our index because it has a chance of being significant in the future, but it's not guaranteed. It's sort of like a wait and see attitude is how I view it. For what it's worth, most people either hate XRP or love XRP. I think I'm one of like 3 people who is like, we'll see. All right, what other questions? Yeah.
So as the institutional adoption grows, do you think that's going to dampen the volatility that we've historically seen? And then second part would be competition for energy, right? So like data centers for AI, all that stuff's like there's only so much energy we have. They want it, they're going to pay for it, and energy is also needed for Bitcoin and other things. So kind of like play out those two things for me.
Yeah, absolutely. So volatility actually has compressed. If you look at the like 90-day volatility of Bitcoin from 2010 until today, it's down roughly 75%. It's down actually sharply even since the ETF launch. So it's come in. At this point, Bitcoin is roughly as volatile as NVIDIA. So that's a very volatile stock, but it's no longer like 3x as volatile. I suspect that volatility will continue to compress as more institutional flows come into the market. We wrote a long-term capital market assumptions piece. We still think Bitcoin will be more volatile than stocks and bonds and commodities for the next 10 years, but it'll be less volatile than it has been in the last 10, more like what it's been for the last year and a half, and even a little bit less than that, because a lot of the risk has been squeezed out of the system. In terms of energy competition, first I'd note that Bitcoin, almost uniquely, but there are a few other assets, is different from Ethereum and other assets because they don't use energy in the same way Bitcoin does. They both have to run consensus mechanisms. The way Bitcoin runs it is they make you solve very complex computer problems. That requires a lot of energy. The way Ethereum runs it is different. They use something called proof of stake, where you put up an asset and pledge to act honestly, and then if you don't, they seize your asset. I actually think Bitcoin will be just fine. The way mining works is that the difficulty of mining can adjust based on the number of computers who are acting on it. What you would worry about Bitcoin is that so much mining would be removed that it would become vulnerable to hacking or theft. But we are so far a long way away from that. So it's something worth monitoring, but it's not an acute risk from my perspective. There are 3 ways to hold crypto. You can hold it in cold storage, which means you hold it in a file that you keep offline and you remember a 12-word password to unlock that file. The other way is you hold it in institutional custody, either directly or through an ETF. That's with a qualified custodian like Coinbase or Anchorage or BitGo that holds it on your behalf with high security. The third way is you hold it in an app in your phone through Coinbase or something like that. This is a bad way to hold a lot of crypto. You wouldn't walk around with $200,000 in your pocket, and you shouldn't walk around with $200,000 of crypto in your pocket, because your crypto is only safe as like the guy at T-Mobile making $16 an hour who will, swap your SIM card in exchange for lunch. And we've actually heard from people who lost significant money. So do one of those 2 things. Either hold it directly in true cold storage and don't lose your password, or use an institutional custodian. I will say the institutional custody is extraordinary. We use Coinbase. They're a qualified custodian. They have insurance in place. They have elaborate security procedures. When we move crypto, it can only move to whitelisted addresses. So there's no way that even people could coordinate to steal it and move it somewhere. I think they have an extraordinary track record. If you get a capital Q, capital C qualified custodian, there are probably 5 or 6 in the world that I would trust, but Coinbase is one of them. Great. Yeah.
Related to that security question, how big a risk is quantum computing in terms of, breaching and encryption?
Yeah, absolutely. Great question. So for people who don't know, the reason quantum is considered a risk is that the cryptography that underlies, let's say, Bitcoin is based on the law of large numbers, which is I have a password that's a lot of numbers, and if you could guess it, you could steal my Bitcoin. A traditional computer would take 1 billion years to guess it, whereas a quantum computer could theoretically guess everything at once, right? So that is the risk. I think it's more nuanced than most people think. So most people think if they have a giant quantum computer, it'll crack Bitcoin and that will be it forever. That's not true. The underlying core algorithm of Bitcoin is not capable of being cracked by quantum. The risk is that there's about 5.6 million Bitcoin in old wallets, and those wallets are subject to quantum risk. I don't worry about it because the same cryptography that underlies Bitcoin underlies how your bank works, underlies how the internet works, underlies how military codes work. So people are going to develop quantum-resistant cryptography long before I think there's a steady-state quantum computer. Otherwise, we should worry about the nuclear codes, not about our Bitcoin. And then can Bitcoin upgrade to incorporate that? I think the answer is yes. The challenging part is there's some coins that are lost, like Satoshi's coins, that could theoretically be taken by quantum computing, and there's no one to move them to a safe wallet because Satoshi is dead or missing or gone. And what happens with that? Bitcoin will have to answer that question. I have thoughts on how it will answer that question, but Bitcoin is thinking about those questions now. I think quantum is a little bit like the Y2K bug for people who are my age and older, which is, if you remember, people were worried about the Y2K bug. They did a lot of work to fix computers before the turn of the millennium, and that made the Y2K bug not a thing. Quantum is a little bit like that. If we didn't do anything on quantum, it would be a real risk. Those 5.6 million coins could be taken, sold on the market, etc. If we think about quantum carefully, we can resolve that risk. And I suspect the community will be able to do that. Indeed, there's been a lot of work over the last 6 months to sort of prepare for that. Great.
You want to take advantage of the tokenization of transactions and stablecoins. I know you mentioned Ether as a way to sort of benefit from that. Any other ways?
Yeah. Yes. You need a 2-part portfolio. And maybe we'll do one more question after this. So you need to hold the crypto assets that are the pathway on which that works. And the top ones are Ethereum, Solana, Chainlink, and Avalanche. They're probably the 4 that you want to own, maybe XRP as well. But that would be the crypto asset side specific part of the portfolio. But then you don't really know where the value will accrue. Will it accrue mainly to those, or will it accrue mainly to the crypto equities that are building in this space? So I would supplement that with crypto equities, maybe 50-50. You could either own an asset like BITQ, which just holds it, or if you wanted to be more active, you would target it and focus on the firms that are building specifically in that space. So that's like Circle, Coinbase, Robinhood. Those are probably the biggies. There are probably a few more if I spent more time. So those 4 or 5 crypto assets, and then maybe 4 or 5 companies, and maybe equal weight them. Just knowing that where the value accrues is as yet undetermined, but the scale of the market is going to like 300x, I think is how I would approach it. All right, any last question? All right, with that, thank you all for listening. Appreciate it.